With the session you've tuned in for today, Rob Ansell, Director of Business Development at Opus Fund Services, and Danny McGuire, a partner at Citrin Cooperman, will be discussing the importance of regular fund administrator reviews and recommending specific questions hedge funds should ask to ensure their position for success. Before I turn it over to them, a reminder of Maine's upcoming in-person event, which is next Wednesday, October 8th at 5:30 p.m. The event's topic is the Great Regulatory Rollback of 2025, a look at how a changing of the guard at the SEC has overhauled the regulatory landscape and what it means for the alternative investment industry. Panelists next Wednesday are going to be discussing what's going on as regards the regulation of investment management and market participants. Why the pendulum swing? What will be the outcome for investors, the markets, and the financial system? And what do these changes mean for your own compliance and risk management programs, especially at smaller firms? You can find information about that and become a member at the manhattanain.com website. Now, let's turn things over to Rob.
Hi, thanks, Bruce. So my name is Robert Ansell. I'm with Opus Fund Services, and Opus is a multi-award-winning fund administrator. And I guess what's most relevant to Maine and its audience is that we have this exceptionally strong reputation working with emerging managers, helping them launch and scale, which is one of the key raison d'etre for Maine. Personally, currently live in New York. I've lived in New York, Hong Kong, London. I've worked on the sell side with ING, Barings, and Macquarie. I've worked on the buy side of the fund. And when I was at the fund, Opus was my fund administrator, so I got to know Opus intrinsically. And then the opportunity was there to actually work with Opus, and I've been here for the last 3 years. Danny?
Great, thanks, Rob. As Bruce indicated, my name is Danny McGuire. I'm a partner here at Citrin Cooperman. I focus on the audit side, but we are a full-service accounting firm. We do audit, tax, advisory. I specifically work in the financial services area, focusing on hedge funds, private equity, VCs, as well as broker-dealers. I've been with Citrin for 3.5 years now. Prior to Citrin, I spent 24 years at KPMG. Again, thanks everyone for being here, and I appreciate your time this afternoon. I'm thrilled to be moderating this conversation with Rob, who brings a deep expertise in fund operations as well as administration. Rob has worked, as he indicated, with a wide range of asset managers, from emerging funds to institutional platforms, and has seen firsthand how administrator relationships evolve over time. Today's topic is one that's often overlooked until it becomes urgent: evaluating and managing your fund administrator relationship. With increasing complexity in reporting, regulatory demands, and investor expectations, the administrator is no longer just a back office function. It's a strategic partner. So let's dive into how we assess this relationship, manage change, and make smart decisions when considering alternatives. Rob, let's start with the basics. What are some of the top signs that a fund administrator may no longer be the right fit?
Sure. I think before we jump into that, I think it's important to highlight, why this is important, this topic. So people switch administrators a lot. And ultimately, it's not something that you want to do. When you start the process, when you're choosing your administrator, the intention is obviously that you're going to stick with that administrator, for a long time, for the life of the fund and hopefully for future funds. But it doesn't always pan out that way. In fact, at Opus, over 50% of our assets under administration were actually at a previous administrator. So, we at Opus have benefited immensely from managers that have moved administrator. So ultimately, it's a disruptive process, and the more thorough that the manager is at the beginning, then obviously the better. And in our experience, you've got to have a very balanced approach for when you select your administrator. And by balanced, I mean you've got to factor in price, service, technology, location, reputation, ownership, strategy. You know, all of these things are important. And I think managers that just focus on one are the ones that we see most when it comes to them looking to switch. So, you know, as like for setting the stage, you need to look at many factors. In our experience, from what what we've seen, the managers that just have a laser focus on one factor are the ones that are most likely to switch at a later stage. So you just asked me, like, what are the top signs that, you know, the administrator, you know, might not be the right fit? I think there's a couple that I can think of. You know, the firstly is if we see repetitive errors. So, you know, in our world, you know, accuracy is non-negotiable. And if we see, or if you see the manager, the same mistakes keep happening, that more than likely tells you that process is manual. And if this process is like central to your fund, then this needs to be addressed. You know, nowadays, and I'm going to touch on this later, we're moving, you know, as much to be automated as possible, and I'll go into that more detail later. But I think, you know, one of the issues is that if there's too many manual tasks, that will result in errors. Secondly, is when you see the responsiveness drops. So if the speed of response from an administrator to a manager, that's a choice. And if you as the manager, you know, if you notice that the length of time that it takes to respond is getting longer and then stays that length or even increases even after, you know, you've made attempts to change it, you know, that's kind of, again, another sign that your priority has shifted within that administrator. And then lastly, I think, is like nimbleness. And ultimately, you know, new opportunities, new technologies, that's constant. And you need to have an admin that can react to both your needs and also the market needs, you know, be they regulatory, be they on the investment side, be they on the investor side. And like, if you find that your admin like can't keep up now, then that gap is only going to widen. You know, if we think about the pace of change. So basically, what I would end with is that being nimble is a rare commodity, and not everyone has it. You know, many admins have a lot of legacy infrastructure, which slows them down and definitely inhibits their ability to be nimble in this market. But what about you? I mean, like, if I just flip that, Danny, what about you? You know, I mean, with regards to on the audit side, and I guess this is I'm sure a lot of, you know, anything you say will also be relevant. Are there signs that you also see where, like, the auditor and the client, where that fit isn't there anymore?
Yeah, one thing I can add to that comment is turnover. You know, oftentimes when there's significant turnover, that can be a sign of a red flag. So if your point of contact is changing every few months or every year, and you've got a new point of contact, sometimes it's hard to build that trust and maintain that consistency of a relationship that you want to build. So that's one of the red flags that I look to is the turnover component.
Yeah, that makes sense. I'm also going to touch on that later. Okay.
Great. And so, you know, continuing this topic, but when a fund suspects that the relationship has been strained, how do they structure a formal review? You know, what areas should they be looking to and assessing? Is it reporting accuracy, responsiveness, you know, tech stack? You've touched a little bit on this, but is there something else as well?
Well, it's kind of, I'm going to answer that in a slightly unique way. And, you know, ultimately, when you are a manager, you're looking to not just solve your current pain points, but you also want to set yourself up for long-term success, long-term stability, and operational robustness. And you can do this. This is achievable. And the way that we help managers achieve this is by going behind the scenes. So if you think about like a normal selling process, for use of a better word. So if you're a manager and you're, speaking to various admins, you're going to be speaking to maybe people from the business development team. You might have people from operations on, people from the fund, the portfolio accounting team on, maybe someone from client services. You're going to be shown the portals. You're going to be shown the front end portals, i.e. the manager portal that you're going to use, and you're going to be shown the investor portal for your investors. So that's pretty much a standard process, which is, has been happening for long and is still ongoing. But what we do is we dig deeper, and we basically go behind the scenes, and we don't just show like the front end portals, but we show like the technology, the processes, the automation that drives everything. So it's not just about what you get shown, or what the administrator wants to show you. It's more about okay, prove it to me. Prove these processes work. Prove the automation. Prove the technology. Because for something that is quite common is what we call, or the industry calls, vaporware. And vaporware is, let's say, I demo you a piece of technology, and it looks great, it's shiny, it's beautiful, but then when you actually go to use it, it's not there. It doesn't really exist. It's just a shiny object. So ultimately, for you as the manager, what you need to be doing is going behind the scenes. And as I said, we call this an open kitchen. And the analogy there is, you go to a restaurant and you order your food. And if the food just comes behind, let's say, a closed kitchen door, it's brought in front of you. It's like, great, the food's here, looks great, but you've no idea how it was prepared. Versus you go to a restaurant and then you can see the kitchen. Maybe there's a glass window or it's just open. You can actually see the chefs preparing your food. And that's what managers need to do. They need to see how is the work done. Because if it's done in an automated, controlled fashion, the administrator is going to want to show you. They're going to want to show you how it's being, how all the work is being done. If they've got something to hide, they're pretty much not going to show you, and they're going to focus on front-end portals and focus on just lining up people in front of you. So these are the key things, and I'm happy if people want to contact me afterwards and I can go into these into more detail. But basically, the things that you want to have and the things that you should be asking your administrator, like, do you have fragmented data models, or do you have a single database? A single database is absolutely preferred and is the most operationally robust platform. Do they have spreadsheet workarounds, or are there systematic controls? Do they have like copy and paste data transfer, or are there digital, STP workflows? Do they have manual sort of processes and firefighting, or do they have like digital agents do the work and then have the humans to review it? Now, in our experience, we think that managers should demand all of the above. So those four key areas that I mentioned, managers should demand all of them. Because I'm convinced that if an admin had all of those, they would be showing you. So when it comes to the review, you want to be going behind the scenes and think about that open kitchen concept in your mind. As a manager, think about, okay, it's not just seeing my NAV statements, my reporting, my balance sheet, my income statement, my treasury controls. I want to know how it's being done, who's doing it, what are the processes, what are the controls, what are the technology, what's the automation. So that's those are the questions that a manager should definitely do at the beginning of a process on the new launch. But then when it comes to, some of the areas of concern, and if they are thinking about switching, they should be doing this, asking these questions of their current admin, because they probably didn't go there at the beginning. And if they go there now and they realize actually, behind the scenes, there's loads of manual workarounds. There's all spreadsheets. Whenever there's problems, they're just throwing more people at it. The controls, that the automation that I was told was there, isn't really there. So that's what managers should be demanding from their administrators. And as I said, if the administrator has all of this, they would be more than happy to demonstrate it.
Rob, that's fantastic insight. I mean, there's a lot of detail that you've given there, and there's a lot of consideration that needs to go into those factors and thinking through that. And that's why we've got you here today, provide this insight for those listening on this call. But let's jump a little bit to kind of managing change, within the current relationship. You've got funds, they've got current relationships. There's things that may change through that relationship. Let's talk a couple of points around that. So if a fund identifies certain performance gaps, how can they approach those issues constructively without damaging the relationship that they currently have with their fund admin?
Engagement is so important. A few minutes can save you many hours. I'll give you an example. So our client services team checks in with every single manager once a month. If the manager doesn't pick up, they leave a voicemail. My advice is engage. So when the administrator calls you, don't just brush them off. Don't just say, "Oh, everything's good." Just think about it. Take some time. Take some time to respond, to reply. Tell the admin what you're up to. Tell them about expected or potential expected changes in like strategy, in structure, in people, in investments, in investors. Take the time to give the admin a heads up that this is the stuff we're looking at. This is things that we might be doing next quarter, next year, because that information, it all gets logged. It then gets disseminated to the respective teams. So it just gets us ahead of the game. And then, so if the manager takes that time to engage with us, then we can be prepared. And then the more prepared we are, the less strain there's going to be, the less performance gaps, those were your words, that there'll be. If you currently don't have this monthly check-in with your admin, then I recommend you set that up. Now, listen, there might not be something to say every month. But if you take as I said, you take a couple of minutes, it's going to save you hours in the future. So engage is my advice there.
Right. Don't assume that the fund admin is aware of a change that's occurring, that may be occurring, strategy change of that nature. Just don't assume that they know. Engage, have that formal communication with them.
Yeah, it's true, because sometimes as a fund, you might spend, have many meetings internally discussing about adding a Cayman entity or adding a new strategy. Oh, should we do that to the existing fund or set up a new fund? You might have all these conversations and then only at the last minute bring the admin in, by which stage your thoughts are quite mature, quite evolved. You're ready to get moving, but everyone is playing catch up with you. So yeah, absolutely. The earlier you engage, the better. And even if things don't materialize, if they do, then the issues don't arise. And remember, everything we're doing now is we're trying to, ultimately, we're trying to avoid people having to switch admins. Because it can be done if you do the proper due diligence at the beginning. If you maintain the relationship while it's live, then everyone should benefit.
Yeah, great. Great. So let's pick up on one thing you just noted there, right? Funds often will change over time, right? From day one to year one to year five. Fund may change in size, may change in strategy.
Mm-hmm.
How do you handle when funds want to renegotiate a scope? They want to renegotiate fees or adjust the SLAs. How do you find is the best way to have those discussions while maintaining the trust?
I think so. Trust is a great word. I think if the manager views the relationship as a partnership from the very beginning, I think the willingness will always be there. And it's interesting because, I've noticed recently in language, we call ourselves a service partner rather than a service provider. I think if that relationship from the get-go is a genuine partnership, then stuff you mentioned about renegotiating scope, fees, SLAs, there's a willingness to do it. I think things that sometimes work against managers is that if as a manager you squeeze your administrator so much at the very beginning, on price, on service, on everything, so that there's just nothing left. There's nothing left to give. There's no room to help. Then that's something to be mindful of. I think as a manager, you might want to feel like you've got the best deal in everything, but then just be mindful that there's a chance that could backfire because the admin has just got nothing left. There's no concessions it can make anymore because it's done them all at the very beginning. So as a manager, and the managers on this call, if you view all of your relationships with your auditor, with legal, with your broker, with your tech partners, if you view all of them as partnerships and treat everybody as such, you'll find that there's a willingness to help. What about you? What about in your situation, Danny, when some of your clients come to you on similar items regarding the audit?
You said it key. I like the term you used in terms of it's a partnership from the beginning. And I oftentimes we see relationships with the auditors as, a check the box. We just have to do it for compliance reasons, but we do offer a lot more than that. We provide insight, we provide our guidance. And if you have that partnership that exists from the beginning, that relationship just solidifies over time. You're going to go through up and downs with the fund, right? They're going to have some great years. They're going to have some tough years. And if you have that partnership and the transparency of what we talked about before, the communication that exists between ourselves and the fund, then that's critical to the partnership and the growth of the relationship. And if you look at it, renegotiating fees. Listen, oftentimes the renegotiation is it's a strategic reset. It's not necessarily a complaint of what you're doing or what we're doing from an audit perspective. The fund has grown, the fund has evolved, or vice versa. Maybe it's shrunk over time. That relationship that we've built, that partnership should evolve as the fund is evolving as well. That's how I kind of look at it on my side.
Agreed.
So we have these tough conversations at times through the relationship again. And, are there any red flags that you kind of look to and say, well, okay, I think this relationship may have run its course and maybe it's time to move on?
Yes, I think there's red. I think it's more about red flags from, if we from the manager's point of view. So if I'm the manager, if I see red flags, if I'm a manager, and I've mentioned this before, when I see responsiveness drop, that's definitely, as a manager, I should be concerned, because reputation is so important, and you as an admin, we don't ever want to do anything to harm our reputation. And, if if I'm a manager and I'm seeing this, the responsiveness just falls away, then that clearly shows you that the admin has kind of deprioritized you. So that's one thing which we've touched upon. And the second thing is, if there's just like an unwillingness to change, to solve issues, that would be a red flag. So, as an admin, if you feel that the manager is treating you as a genuine long-term partner, there is always a willingness to help. There is always a willingness to solve your issues. There's always a willingness to work with you. But if you're the manager and you kind of getting negative responses, you're getting, no, we can't do that, or we can do that, but it's going to cost a fortune, or you can sense when the admin kind of just isn't really there to solve issues for you anymore. So that's another red flag, because I think when you're in that situation, it's pretty hard, and you've addressed it and it's still there. That kind of shows that your priority within the administrator has shifted, and then that's a time for you to start looking elsewhere.
Yeah, I mean, one thing I would add to that too is the communication breakdown, right? Once that communication has broken down and you find it almost painful to have discussions, or non-responsive. You touched on the non-responsiveness. I think that's also a red flag in my view, and kind of the audit relationship when we have with clients. Oftentimes, if we're not responding to their calls, then listen, the fund is going to start looking elsewhere, right? They want us to be a partner with them, and if we're not partnering and we're not communicating, we're not getting back to them, that's definitely a sign that it may be time to move on.
Yeah.
Yep. So let's move into into looking and considering a new administrator, right? You've come to the point, either you're a startup emerging manager, so you're now trying to evaluate fund administrators, or you currently have a relationship and you're at the point of, okay, we haven't talked to other fund admins in several years. We want to start having that discussion. That's a big decision for a fund. What are the most common reasons you see that funds are making that move?
Yeah. Okay. So yes, if the common reasons are this is what people tell us. So this isn't like me, making stuff up or trying to badmouth anyone or etc. These are literally, the conversations that we have, and then there's some common themes that we see. So on the one hand, again, I'm using language of what people say to us. We often see that the way that the market structure is that the largest funds keep getting bigger. And the largest funds, the multi-billion-dollar funds are getting bigger. They're attracting the lion's share of the capital, and they're the ones that are doing the most new launches. So if you are the administrator to one of these mega funds, you're just going to clearly, allocate most resource to these guys because they are paying, their fees are in the multi-millions. They're getting bigger. And you're just it just makes common sense. No one's arguing. This isn't controversial. No one's upset by it. It just makes sense that time, resource, etc. goes to your largest managers. But what that does is it leaves a lot of managers feeling neglected, feeling like they're just a number. And these managers are not just small managers. We've had one example where there's $1 billion manager who literally said to us, we feel like a number. And that was quite mind-blowing that $1 billion manager could be made to feel like a number by their admin. But they were frustrated, they were upset, but they to a degree understood it. They could understand that even though they're big, there's a lot of people that are a lot bigger than them that are getting like the A teams, etc. We've also seen a lot of managers in like the $250 to $500 million range, who are saying to us, do you know what? We're not even getting the B teams now. We're getting like the C and the D teams. So there's frustration there. So one of the big switches we're seeing, one of the big trends we're seeing, and it's driven by the market dynamics, is that we're seeing these large established funds who just feel like they're just not getting the service, the attention, and they're paying like a lot of money for it, and then they know that there's alternatives there. So that's one side. We're also seeing a lot of funds that have outgrown their admin, and these are like really fast-growing funds. You know, when they started, they went with, let's say, smaller admins, but as they have, you know, experienced explosive growth, they've just realized that the admin's holding them back. The admin doesn't have the technology or the scale to keep pace with them. So, you know, we see that a lot. And those are really exciting managers because they are, they're growing and they need help. They need the support, the technology, the infrastructure for someone to actually aid them on that journey. So they know exactly what they're looking for. We see a lot of funds who, when they did their initial selection, the name on the door was important to them. That's something, again, these are words that they say to us. And a lot of that is based on their previous experience. So these are managers that were maybe at a multi-billion-dollar shop where they had familiarity with certain admins, where they liked having, you know, being associated with them. But then when they go by themselves, they've still got this affinity, this connection with that admin. But then they realize, okay, I've got the name, but I don't really need an admin that big. You know, I don't need all of these services that I'm not really paying for. So that's something we see a lot. Next, again, I'm just thinking about all the reasons that people call us looking to switch. High staff turnover, managers hate it. They absolutely, it drives them mad whenever there is turnover. And what they find is that when turnover starts, it tends to happen for some reason. It's a bit of a vicious circle, and that when coverage changes once, it tends to change again. And that tends to be, you know, someone leaves, they have someone temporary on that account, and then that person moves on. So fund admins need to solve for this. You have to solve for high turnover because it hurts your business. So we solve for it through automation. So at Opus, you know, our goal is about to automate about 80% of every task, and then we bring our people in for the final 20%. So what that does, it means that our staff are engaged, motivated. They're doing more interesting work, like review work, talking to clients, development work, trying to improve the product, rather than putting out fires and just dealing with manual, laborious, repetitive tasks all day. So not only does our high levels of automation result in low turnover by, you know, having a healthy, motivated workforce, it also helps us attract really good people, because people see what the environment's like at Opus, they see what the type of work they'll be doing, and that's what they want. You know, they want to be adding value to an organization rather than just keeping it on sort of life support. So as a firm, you know, you need to focus on your people as well as your clients. And then the final part of that is that Opus, you know, we haven't lost a client-facing client service person for 7 or 8 years. So that's a really strong statistic. We think that's exceptionally rare, and we pretty much mention that to all new prospects. Other issues, a couple about what last one, Danny, is too much reliance on offshore. Now, I don't really have a strong opinion personally, but we hear it a lot. And admins, you've got to strike the right balance between you know, how much you're doing onshore versus how much you're doing offshore. Because if managers feel that shift to offshore services keeps going, That's not what they want. They don't want to see that trend. There's a certain amount of offshore connectivity and reliance that they're okay with, but if they start to see that creep, they don't like it. And again, I'm just saying that based on managers that have moved to us because they specifically don't want that offshore creep.
Okay, that's, very due though. It's interesting to get those different responses from the different funds, right? It's not one issue it's one issue for one fund. It may not be pervasive across every fund's got a different reason as to why they want to change. So now you've got a fund manager who's made the decision that they're going to change. They've got 3 proposals in front of them. Now, I know this next question I'll ask of you is probably something that you could spend the hour on, but when they're evaluating those new providers, those new fund admins, what due diligence steps are absolutely critical for them to take?
Yeah, do you know what, Danny? I'm actually going to do the opposite. And rather than spend an hour, I'm going to do it really quickly.
Correct. I'm saying you could spend the hour.
No, I'm going to focus on things from our point of view that make the process so much easier, smoother, and efficient. So number one, the manager needs to be as transparent as possible. Get that NDA in place straight away and basically provide as much information as you can. Even if you don't think something's necessarily important, all of the reporting, as much information as you can give to the admin, that is one of the easiest things for you to do. Because for you being the manager, you're just going to just go into your Explorer and you're going to click on all the files and you're going to send them across. But then once the admin gets that, we can spend time, we can put it in front of the relevant teams like the portfolio accounting team, the fund accounting team, the financial reporting team, etc. So then we can look at all of your current reporting, any customized reporting that you've got. So then we can make sure that yes, we can do all of those things. So be transparent, send as much as you can, and then secondly is articulate your pain points. Spend time, be specific, provide examples, and work through what your pain points are. Because this whole process is pointless if your current pain points aren't being solved. But in order for us to know what your pain points are, the manager needs to spend the time to articulate them. Articulate the pain point, articulate what they tried to do to correct it, because there was always a process. If there's a problem, you address it. If it happens again, you address it. So it's not just in isolation. For it to get to the stage where you're now talking to other admins, it means that you've tried, there's been various attempts to fix the pain point and it hasn't worked. So go through that detail, because there's no guarantee the new admin can fix it. It might be something that no one can fix. So spend the time to articulate your pain points. But ultimately, as a manager, what are your goals? What are you looking to achieve? So you are looking to achieve total lower costs. And by that, I mean, it's not just lower fees. It's more about what are the costs are coming down and what are you getting in return for those fees. So it's not just about, I want to lower my costs, because that's just solving half the issue. It's like, well, what am I getting for that? So we call that total lower fees, number one. Number two, make sure that you are moving to an admin that's got institutional quality. And that institutional quality, you can ascertain that through not just the portals, but again, the open kitchen. And asking the admin, okay, the open kitchen was great, the behind the scenes was great. Who else have you showed that to? Which ODD firms, which allocators, who's seen this and what did they say? Next, your third goal is full transparency. And again, by that, I've covered this already. If an admin has it, they're going to want to show it to you. So if we are doing something manually and using spreadsheets, we're going to try to avoid telling you that or showing you that. So as a manager, you want to be like forcing that transparency and seeing how is the food prepared. And then lastly, you want to go into an environment of maximum efficiency. So lower your total costs, institutional quality, full transparency, maximum efficiency. And Danny, I can assure you, if an admin has this, they will want to show it. If they don't have it, they're gonna try to avoid showing it to you.
Yeah. And you touched upon it a little bit, and I just want to maybe put the relationship together. Obviously, cost for fund managers is going to be a consideration, but how do funds kind of weigh the cost versus kind of the capacity, right? You may start with an emerging manager who anticipates to hopefully grow in the next 2-3 years, or you may have a more mature fund. Again, that's still weighing that cost versus kind of the capacity. How do you think funds should look at that?
It's also how do admins look at that, because ultimately we view ourselves as a patient partner. We've got one of the strongest reputations on the street for that, for helping emerging managers launch and scale. But obviously, you can't say yes to everybody. And size isn't everything. So what do we look for? So we look for pedigree. So let's say there's a manager ran multi-billion-dollar portfolio at a multi-billion-dollar fund, but he's going to be starting small. It's like, okay, that pedigree's there. We will back that manager even if he's just launching with a small amount of money. We look if a manager has got like an anchor or a seed investor. Again, it doesn't need to be large, but the very fact that a new manager has been able to get a decent, a seed or an anchor, that is a really strong message. We also see, it's been a trend in the last couple of years. We've seen a lot of RIAs launching funds for the first time. And again, a lot of these funds are smaller because it's their first fund and it's their first foray into this space. However, the RIA themselves, they manage billions. So again, even though the fund may be a small opportunity, we look at the fact of the scale of the whole organization. And there's also things that a manager can do to help, and we can advise them as well, help to bring costs down. So examples might be, and this is where the manager, an emerging manager needs to be open-minded and needs to be open-minded to advice from all of his partners, from you, from legal, etc. So from our point of view, go with a recognized prime broker. Just go with a recognized bank. Like let's say, an unknown regional bank in the Midwest, for example, is could slow things down, could add extra cost. So we're saying be open-minded about who your partners are. For the bank, for example, a lot of times we speak to managers and they go, I've got a really strong relationship with this bank, I want to use them. So we say, great, we'll use them for the investment manager account, but use someone more recognized for the LP account. And again, that's a way that they can instantly save costs. Think about third-party loan services or third-party property managers. Again, that's a way that the administrator can help reduce costs. Can they send data more efficiently? So there's lots of ways that we can advise managers to increase their efficiencies, which therefore will enable us to price better to help get them off the ground.
Yeah, no, that's great. And then, I'll add from our side, one thing is important is if, meeting your deadlines, right? If client says we want deliverables by a certain date, we'll work backwards with them, but they've got to meet their deadlines as well for us to meet our deadlines. And that's why we've got to work together on that and making sure that we can do that. And that oftentimes will save on costs if you can constantly associated deadline as well. So that's important. So funds, he's made his decision. and they want to make a change, or they've picked their fund admin. Famous quote is, right, timing is everything.
Yep.
When do you think is the best time to make a change, and maybe the vice versa? When should it be avoided?
Well, the best time is now, because you've got 3 months where you can do an orderly transition and then have everything ready for the new admin by 1st of Jan 26. So we've had a lot. We're in our peak period of conversations with managers. They've been going throughout August, September. Managers are making decisions now. There's still there's still plenty of time, but the managers that are making the decisions early are now going to have a very orderly handover. So that is absolutely the best time to do it. And it also means that you're going to hopefully arrive on a Jan 1 handover, which means that you don't have to have an overlap. I mean, some managers will insist on it. At Opus, we don't necessarily insist on it. We're not trying to make a manager pay double fees by paying 2 admins at once. So we're very confident in our onboarding process and our onboarding people and implementation, that we are comfortable that we can take it from Jan 1 without having to do an overlap. So now is absolutely the best time to do it. When not to do it, during audit and tax season, just don't. That's absolutely not the time to be doing it. Actually, Danny, what you'll find, interestingly, is that post audit season, we have some managers that call us and just had such a horrendous experience that that's often a catalyst for conversations, is when they've had a really tough audit period where the admin just really dropped the ball and made something that should be painless really painful. And that can leave a bad taste. And that is sometimes an admin will only go through that once. You know how previously I mentioned that, you address something, you address it again, you try to solve it. A really painful audit can do a lot of damage.
Yeah. And then, on our side, from an audit perspective, timing is a little different in terms of change, but anytime, generally what we see is post that audit season, consistent with what you just said, Rob, where it was just a very painful audit, a lot of mishaps could be on both ends, but fund manager just gets frustrated enough that they say, okay, we want to evaluate somebody else, we want to consider somebody else. So it happens kind of post that audit season, right up until the October-November period. On the audit side is when we can consider changing from there. Obviously, once you get into December, January, it gets tougher. It happens sometimes, and as long as you're upfront and straightforward with the audit firm, they can oftentimes make it work even that late in the season.
Yeah, you're right. So that makes sense, because what happens is emotions are very high. Post when the audit's finally done, if it's late but it's done, then emotions are high. And CFO, etc. There's a lot of anger, regret, and an insistence, like, I'm not doing this again next year. So that's so you do see a lot of, that's where you see a spike in conversations. And often the biggest reason that conversions don't happen is just manager inertia, whereby they go through the process, they line up the alternatives, they have all these conversations with us, discuss all the pain points, do the NDA, give us all the information. We go through the whole process, but then at the end, they just don't do it. And actually, I guess this, you mentioned this to me earlier, Danny, about what does switching admin involve? And this is almost like the final piece is getting the manager to do it, because unfortunately a lot of the time they just go, I don't want to do it. It's like people changing bank accounts. It's like, you might hate your bank, but people so rarely change their bank account. They just can't be bothered to do it. They think it's too much work, and they just suck it up and deal with it. So let's try to dispel some of those myths. What does it involve? And ultimately, the admins, both us and the existing admins, we do the vast majority of the heavy lifting. So basically, we get all of the investor information, compliance, AML, portfolio accounting, fund accounting, gap history. So all of that data we get from the existing admins, and it's all in files, and then we process it. So that is the big bulk. That's the heavy lifting. The only time a manager is going to need to get involved in that process is if the existing admin are dragging their heels, and the manager, we give them a call and say, "Hey, can you give these guys a kick? Yeah, can you try to speed this up?" So so that's the only thing the manager needs to do in that regard. However, these are the things that a manager or someone in the fund needs to do. So number one, they need to upload all of their KYC, legal docs, subdoc, PPM, LPA, etc. So all of that, the incorporation docs, all of the information for the fund, the IM, the GP, any other entities, they need to upload all of that to the new admin. So that's one task. Next is you have to update your current legal docs to reflect the change of admin. Obviously the subscription document and the PPM. Next, you've got to update your investors. But this should be a positive experience, because by that stage, you're going to be able to demonstrate and articulate some hopefully significant improvements to the operational robustness of your fund, the institutional platform of your fund. So that should be a good experience. And then lastly, you're going to need to review, approve, and sign the new service agreement. So those are like the four things that a manager needs to do. It's pretty painless. The admins do most of the heavy lifting. The stuff that I've mentioned are the things that the manager or someone at the fund needs to do. And so my advice is, if you're the manager, if you think about how much time am I going to have to allocate to this? Well, the answer is the biggest amount of time is speaking to the new admins and understanding, getting your pain points solved, understanding that you're going somewhere that's better, that ticks all your boxes, that is got scales, got automation, can help you grow, is engineered for growth. So that's where you want to spend your time, because the actual mechanics of the conversion are not as scary as a lot of managers think.
Yeah. Well, Rob, this is, I can tell you, has been incredibly insightful. You've had so much information here you've provided for fund admins, for fund admin on your side, as well as funds to consider what to do, when to do it, how to do it, what they need to think through on that side, working with their current fund admins, working with their current teams at the funds. Again, just a lot of great information.